So I am so excited to be joined here on stage with two of my favorite people in the digital asset accounting and tax space. I'll let you guys introduce yourselves. Mel, why don't you go first?
Okay, I'm a co-founder and CEO of Fuel3. We do outsourced accounting and CFO advisory services in the crypto space.
All right.
Rob Massey, I lead Deloitte's crypto practice on the tax side. Been doing this for 12 years, so I founded our practice back in the day when it was a very quiet experience in the firm, but super excited to be here.
Yeah, and I'm Amy Kalnoki, co-founder and COO of Bitwave. We make a digital asset accounting subledger, a full suite of tools to help with tax tracking, bookkeeping, RevRec, and yeah. All right, let's get started. So Rob, as the industry is maturing, the IRS is becoming a little bit more active in their exam activity. When you get, as you like to call it, a little love note in the mail from the IRS, what's the first thing they're going to ask you?
Yeah, so when you do get the little letter, your contact for the first time, know that while it's the first time you're hearing from them, it's not the first time they've thought about you. We're all enamored with this concept of transparency, right? Guess who else it's transparent to? The IRS. That means they've probably scanned everything you've said, whether you've done it on a stage, whether you've tweeted about it, whether you've used other social media. They've correlated all of the stuff that you've said publicly with sometimes what's happening on chain. They will actually query the protocols. They may actually go into a public GitHub repository, look at the code as it's being created, and what do we love about GitHub? It's all the little comments and chats and the intentions about what these actions mean. Meaning the first time that they've shown up, when they send you that note, they already have in their head what you're all about and what you've done. Fascinating. And so we have to be uber prepared when they send you that note. The first thing you're doing is like, oh, what is transparent to them? What is the narrative they've probably formed, so that when they show up in that first meeting and you want an opening conference, you don't want to just respond to the IDR. You ask for an opening conference where you now control the narrative. This is what we're about. Tell them the story. Tell them what we've thought about. Tell them about how we've correlated the data that is available on chain back to books and records and what's been reported on the returns, so that we can tell the story in a complete narrative and grab it on the front end so that we don't lose control. So dropping a heavy anchor in that first meeting.
Yeah, books and records, that sounds like accounting to me. Mel, you, I'm sure, help your clients keep good books and records all the time. Maybe talk a little bit about that.
Sure, we do. I like to call it, when the IRS sends that love note, is from a practical purpose, there's a couple things you need to do. I think you start with summoning the experts. So if a client tells us about it, first thing I'm going to do is call Rob and say, Rob, we have an issue here. Then, blast open communication channels. Let's make sure everyone that needs to know is on that communication thread. Then unleash the paperwork, okay? And the paperwork is all the financial statements, reconciliations, analysis, all the backup data, the raw data as well. And then another, I think, important aspect is I call it the unite phase, because a united team makes it harder for the IRS to win. And then the last thing I think about is embracing the order, in terms of making sure kind of the housekeeping is in good shape in terms of the document flow, as well as maintaining a well-curated library. So you know exactly what you sent, you know exactly what the IRS has seen, and that kind of helps some of the chaos. But in terms of the paperwork, Amy, to your original point, the basic good accounting process is going to be really helpful to get you through this IRS situation. And that's really having a proper and rigorous monthly close, putting together reconciliations, and I mean all your reconciliations. Yes, you have to reconcile your digital assets, and yes, it better be a three-way reconciliation between the blockchain, your subledger, and your financial statements, because the last thing you want is a panic scramble when the IRS is knocking on your door to try to put these things together. And those all result in putting together financial statements for your client. Balance sheets, P&L, statement of cash flow, other analysis that are important for your business, and having conversations with your clients so they know what's available.
This point of reconciliation is a big one, because go back to old world. they're reconciling things in your books and records eventually back to cash flow and bank accounts. But we have a much wider range now of where transactions come from. And that one of the first requests you're going to get is, give us a complete list of your addresses. Now they're gonna show up for the first time saying, you're trying to hide something. That's just because, you know, people read the paper, they watch the news. It's all about criminals, right? We know better. But that is their first assumption. So they're going to completeness, meaning reconciling of the transaction flows on those addresses. They're going to query the protocols, look at all the input and output transactions, and they're going to say, show me how those transactions, every one of them, reconciles back to the books and records you've produced.
Yeah.
Now, we know that we move stuff between addresses all the time for various reasons, and that's fine, but the IRS is going to start by assuming every one of those is a financial transaction. It may not be. You're just moving it from one of your wallets to another. It's fine. But we have to prove that out, making sure, again, we have the narrative on the up front, and if something doesn't reconcile or if it's not explained, you want to know this in advance, making sure that you control what were your intentions were. If it wasn't documented then, let's make sure we explain it now before they ask the question.
Because the burden is really on you to prove that you've properly reconciled all these. Yeah. And at Bitwave, we like to call, we have the concept of wallet hygiene. It's really important to be keeping track of your wallets and all your transactions, intercompany or otherwise, from the get-go early on, because it's a little too late to start figuring this out. Once you bring in Rob and your tax team, you have to be doing it all along, to Mel's point.
And you know, one of the beauties of a subledger like Bitwave, which we've used in, you know, gotten us through financial audits, knock wood, haven't had an IRS audit yet, is that everything that you talked about, Rob, really gets contained within Bitwave, so that you could run a report to understand what was just transferred from one wallet to another and easily produce those reports for the IRS.
And demonstrating how much effort the management team has taken place on the front end. Yeah, we know this is important. Here's all the work we've done. Yeah. We've engaged appropriate software, right? We've used it to its fullest extent. We've collaborated among us. All of this should come through in that very first opening conference, that first narrative. Here's all the efforts we put forth. Now they're like, oh, okay, these guys have taken it serious. And then as they're asking questions, as you're answering, you're putting forth documentation, you've now reset their expectations. They've gone from starting off assuming, hey, we're going to be dealing with some nefarious stuff. We've now reset them to, oh, these guys have tried to do the right thing. Now the question becomes, hey guys, here's the questions we're trying to answer. Help us get through this most efficiently, right? Because remember, they're graded upon the speed and the accuracy of an exam. If you all of a sudden reset their expectations, these guys are trying to do the right thing, you actually can get them on your side. But you have to demonstrate that hygiene, collaborating between how they've utilized the tools, how they've utilized and put it into their books and records. They've confirmed every transaction. They've been thoughtful about it. Contemporaneous documentation, contemporaneous decisions of management, going back through these transactions is critical. So you can tell I've been through exam a couple of times on this, but it's different from exams of the past. It's very, very different. And so it's a little shocking at first, and then you get it, and then you never forget how the breath of a dragon smells once you've been in the face of a dragon, right? You remember that. And
I just want to make one point is, I know people may be thinking, you know, the likelihood of me getting audited by the IRS is pretty low, and maybe it is, or maybe it isn't, but there's more reasons for you to have good accounting processes, a good accounting process to start with. I mean, first of all, you're running a business and you need to understand how your business is performing, number one. Number two, you've got investors you've got to report to. So you want to build their confidence in you in terms that you're serious about running this business. And you've got, you know, potential investors who you're going to have to tell a really compelling story to and back it up with financial statements when you say, I want some more money.
Let's switch gears a little bit. So there was recently, not too long ago, a staking revenue update. Yes, Rob, maybe chat with us about that.
So the IRS recently came out with a revenue ruling which clarified what staking rewards represent to them. And this has been a debate for a long time, and there was relatively little guidance out there on point. But this is the first time that we have an expressed point of view via the IRS in terms of revenue ruling. So what does this represent? It is their point of view. Revenue rulings are not law. but it is guidance that is authoritative, meaning this is their point of view. Meaning that if some of you decide that you have an alternative point of view, you're relying on advisors saying this is not income yet, then you're taking a position contrary to what the IRS views as appropriate, and you should probably disclose that on your tax returns. Unfortunately, this is the way the world works, right? Even if you're like, no, I have a position, it's okay to not claim these as income. If you have that position, good on you, but you probably need to disclose it because you're taking a position contrary. So it's not quite law, but there is an express point of view out there. So and we also have accounting guidance on this, yes?
We do. And this is where the fun really begins, and where a subledger like Bitwave is going to help us out, because you really have to track trigger events for revenue recognition. So from a GAAP perspective, the revenue recognition rules are going to be different than for tax. So, and obviously the book recognition will happen first. And the things you have to keep in mind as accountants when we think about revenue recognition, we think about, okay, we have to understand that there's a contract, and we have to understand what performance obligations we have in that contract. We have to understand what the price is related to the performance obligations. And then if there are multiple performance obligations, you somehow have to allocate the price. And then when the performance obligation occurs, ching, okay, we book it as revenue on the books, but not for tax, Rob. How come?
It would be unfortunate if the timing was different. So let's say, so the revenue ruling basically says staking rewards are income, right? At the time that you have dominion and control, which is when you can do something with it, right? Which isn't exactly the GAAP rule, but you would make yourself nuts if the timing of revenue recognition was different. And so what we need to do is go, and you hit on it right, what are the contracts? What are the relationships with the parties? There's all kinds of different scenarios. Some people are operating their own nodes. Some would use a custodian, some would use staking and service provider. And so understanding those contractual flows, what does it mean with a GAAP lens, put in the tax lens, and then try and build policies and procedures that support, this is our methodology that supports both. You hit on pricing really hard because some of these things happen within seconds, right? And even the Treasury regs that just came out, which is different set of rules, but they even reference pricing at hours, minutes, and seconds. That is what they're looking at. The books and records are like, what are you talking about? That is nuts. So now we talk about pricing oracles, and what if there's different trading pairs out there? So these are all considerations to build in. At the end of the day, if you were exercising a high level of care, building it into your software application, building it into your books and records, really making an attempt to get it right, you're going to start off on the right foot, right? Does it have to be absolutely perfect? Probably not, but you better make an attempt, because they're making very bold statements about the level of accuracy they want when you're picking something up in income. And so nuances to the roles that you have, and again, there's lots of different points of view out there as of what staking represents. This discussion is far from over, by the way. The fact that there's a ruling produced doesn't mean that that's the end of the story. There's points of view that will eventually be expressed in one of three ways. There's either going to be expression through Congress, which is still bouncing around through bills and what staking rewards represent. That will still happen. This may be litigated in court, tax court, district court, I don't know. But there are people willing to litigate this. Back to the point of people putting in their returns, that could happen. Or there's enough range in Treasury to write Treasury regulations. That is law, if they choose that path. So one of those three things is probably going to happen. In the meantime, be aware. The IRS has expressed an official point of view. This is income. The timing is when, how do you record it, good hygiene. Even if you're not picking up into income, you need to record when you got those things, right? Record them, whether it's GAAP or tax, record them in your books.
Yeah, exactly.
Yeah. I guess, Mel, and maybe elaborate a little bit more on the month-end close. And are people keeping two sets of books? Are they keeping a separate tax book and a separate accounting book? Because you just mentioned that, GAAP can vary from tax-related things.
No, generally you wouldn't, but you need the underlying data. Like, for example, using Bitwave, okay, I can run reports that will give me what my cost basis is, what my basis is for tax. I can look at my gains, my losses.
Yeah.
So in terms of like the bookkeeping, it's kind of like we do it once, but like we use the reporting features to give us many different sets of information, and that's really important to us.
Maybe define what cost basis is. I'm not sure if you're not an accountant or working on your bookkeeping.
Sure. So cost basis is the amount, is basically what you paid for that asset when you acquired it.
Yeah, perfect.
And there are differences between GAAP and tax on things like transaction fees, right? The new GAAP guidance, I think, would tell you that you expense those things.
Correct.
Versus
yes.
for tax, we capitalize those things. And transaction fees here are a little nuanced, right? It might be a commission you pay. Sometimes there's gas fees on top of that.
That's right. Yeah.
And then what's even more interesting, and this gets to the new Treasury regs that are now almost a month old, which get to information reporting, but it is really instructive about transaction fees. And what they've said on the topic of cost basis is that if you have transaction fees that attribute to an exchange of two digital assets, swapping one for another, then you take those transaction fees and you split them in half. What are you talking about? Part of it is attributable to your disposition, your gain and loss calc. Part of it is capitalized on the new asset you just procured. Really hard. These are proposed regulations still bouncing their way through, but now we need to learn to account for this brand new muscle that we're building here. We have to account for our books and records and in the systems. These are proposed regs, but they're pretty deep. It's very thoughtful law, and this is coming around. We need to start building this muscle into our hygiene, particularly those who have a lot of transaction fees that they're churning. Let's get this right. Again, best attempt to get this right.
Yeah. So maybe let's touch on valuation a little bit. How do you value the assets that you have currently?
So, well, that's really interesting because, with the recent FASB, once they put that into effect, the nice thing is we get to adopt fair value accounting for, specific types and classes of assets. Your NFTs will never be fair valued. They're going to be impaired, which is, and the fungible tokens have the better chance of being fair value. So that really sets up a whole cascade of things that we have to think about in terms of what do we do with the prior reporting where we've impaired assets that now we can trigger fair value. How are we going to manage that? Adoption time as well is set to go into effect for 2025, I think, or it's after 12/15/2024, so years in 2025, unless you want to early adopt. And once FASB approves it, then we can adopt it then. So there's a lot of planning that's going to need to go into this from our perspective, just from an accounting role.
And then remember, this is what GAAP tells us to do. Tax, it needs to be aware of what GAAP is doing, but we don't, unless we have a recognition event with our digital assets, then the tax book may not be impacted by what the GAAP rules tell us to do, which gets again to very meticulous bookkeeping. Best practice to build all of these considerations into your books and records. Make sure your software, Bitwave, is able to see all these things and reconcile, okay, here's this tranche, here's this set of digital assets, which may have been fair value adjusted, but that doesn't impact tax. With the transparency in your books and records, that's how we know what to adjust out, so we get the right stuff on your tax return. And then if you're using Spec ID, which lots are we talking about? So a lot of things baked in, but it sure feels like the IRS and Treasury more broadly understands the intentions of management to choosing one versus another, the adoption of specific ID. It's a thing. It's appropriate. We just have to build it into books and records to show contemporaneous documentation.
And one thought, show your accountants and your tax people some love. It's not easy what we do.
It's true. Show them love and provide all your wallet addresses.
Yes.
Everything to them up front. All right, any final thoughts before we go?
This is
all
great.
Right.
I mean, it's nice to
Good.
see so much collaboration. Love collaborating with you guys in the market.
Yeah,
It's so fun.
absolutely.
And if anyone has questions and I'm walking around, feel free to grab me and ask me about one of these topics.
Perfect. All right, thank you so much. Have a good one, everyone.